Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I'm Arjun Patsarthi. And in Let's Talk Bonds podcast, we talk about the best options available for fixed income investors. And given the current interest rate environment, other macroeconomic environment, and other factors, including credit, specific credit factors that can affect fixed income investors and their portfolios. And given the current uh, environment, this week's podcast is on whether you should dramatically reduce the duration of your income portfolio. And if you're a financial advisor, the best place for you is INR Bonds Partner Portal, where we showcase the best bonds available to operate clients' portfolios to their to their to the strategy that you recommend to them, with the most information on the bonds and the best of easiest of investment processes for your clients, along with the most transparency in prices. Log into INR Bonds Partner and become our partner and see your fixed income assets grow. And coming back to let's talk bonds. Uh, in this, like I mentioned, should you reduce the duration of your fixed income portfolio? So, what should be the duration you should look at? Now, let's see. Should you reduce? What are the factors that is into 23 that is going to drive the returns on the fixed portfolio? The first is that um, we are staring at the market staring at more rate hikes by RBI, the Federal Reserve, and other global central banks, because inflation is still way beyond their comfort levels. And there are other factors that are still preying on inflation, largely because of the fact that there's so much of money that the central banks have pumped in collectively into the markets, which has driven up asset prices and all other prices, which has really led to a structural shift in inflation. And this cannot be undone in a hurry. So the central banks clearly have to recalibrate their thinking both on liquidity and on interest rates. So that's the first. The second is that in India, RBI, the government is coming out with its budget in February, and typically budget is always more borrowing, and by the government and the states, and more borrowing, more supplies, and all this at a time when interest rates are still higher. And the third is that if you look at the yields in the market, in the US, the yield curves are inverted. In India, the spread between 1 to 10 year or 1 to even 40 years bond is not very high. In fact, if you look at 3 to 30-year G-Sec, they're all trading in a very 30 basis points narrow range, around 715 to 7 to 740, 745 levels. And typically in this period, you can even find 2 to 3 year bonds offering better levels than 10 or 15-year bonds in corporate bonds. So given this, there are not difference in yields. Even if the market believes that after 1 year or 1.5 years or 2 years, interest rates can come down, there's not too much of joy in longer dated bonds. The only joy that can happen is the uncertainty that you can get. Maybe it can add some excitement to your portfolio, but that's about it. Hence, in this period, it's what staring at interest rate hikes, borrowing, you have other uncertainties, you have longer term periods of high interest rates. All this is going to prey uh, into the market's mentality, and it's very difficult to see any kind of movement along returns that can be available for long duration portfolios, except given a risk, given that the risk is pretty much higher than what it was earlier. So with this, if you're, it does make sense to calibrate your fixed income portfolios, make it extremely short to maybe even maximum of 6 months to 1 year. Invest in bonds, short duration, short maturity bonds, 3 to 4, 5, 6 months, which can give you better yields. And GSEC, Bharat bond ETFs, and other uh, similar products, and take it up to maybe um, up to 1 year or slightly over that. If you are looking at higher credit risk, you can look at some good bonds that can give you some decent yield pickup even for a shorter period of time. What this effectively does is the maturities are much shorter. You can reinvest this with more clarity on where interest rates are headed, and maybe a better return going forward. Basically, you are yourself for protecting your portfolios. So financial advisors looking to recalibrate their clients' portfolios can look at reducing durations and making sure that the money comes back faster to the clients for so that reinvestment levels can be with more confidence, clarity, and even at higher levels of returns. Uh, in the private placement market, we did see some very decent levels. 1 year Kotak Mahindra Prime, 1 year at 7.8%. Axis Bank issues 1 year at Axis Bank Limited issues 10-year bond, sorry, 1 year bond at 7. City Corp Finance, sorry, City Cap Finance issues 3 year bond at 8.24%. Bajaj Housing issues 3 year bond at 8 um, 7.83%, and Cholamandalam issues 3 year bond at 8.30%. So 3 year bonds are seeing these very decent levels from good AAA names. Apollo Hospitals issues 2 year bonds at 7.7%. And Axis Bank, I think they came out with a very large issuance of longer term across maturities. And in the other space, you had the whole Bharat bond ETF, the new Bharat bond ETF bonds, 11-year bonds in IRFC, NTPC, Hindustan Petroleum, NABARD, PFC, all in a range of 7.43% to 7.58%. So these are the levels. So investors getting 6 months to 1 year paper at 7.4, AAA papers at 7.4 to 8%, or 2 year bonds, 2 year bonds at over 8%, 2 to 3 year bonds can definitely um, look at these bonds if they want to reduce their portfolios. Just to give you the risk of bonds, clearly investors and advisors should know that bonds carry interest rate risk, credit risk, and liquidity risk. And you should be aware of all the risks that are before taking investment in the bonds.